Hi, I'm Hortensia Lobe. I am a CPA and AI consultant. Today, I would like to cover cost segregation studies, what they are, why they matter for real estate investors. A cost segregation study is basically a technique that consists in breaking down your property into various asset categories of various useful lives. When you don't perform a cost segregation study, the standard method is to depreciate the value of the building over 27.5 years. Let's assume you purchased a property with a building value of $200,000. You're only allowed to deduct about $7,000 every year. This is basically the 200,000 divided by 27.5 years if it's a residential property. But now, when you perform a cost segregation study, you are able to identify assets of shorter useful lives. For instance, you have your appliances, you have land improvements. When you identify those shorter life assets, you are able to deduct the value of all the assets with a useful life less than 20 years. Let's go back to the example of a $200,000 building. Let's say a cost segregation study identifies 40,000 is the value of all assets with a useful life of less than 20 years. You are able to deduct 100% in the year the building is placed in service. In this case, you're able to deduct about $40,000, which is a much larger deduction in year one than in the first example, where we identified only $7,000 of deductions. If you're interested in this technique, if you would like to learn if it applies to your specific situation, feel free to reach out, contact me. I would love to work with you.